Japan's foreign reserves fell by a record amount in the month of October, marking 3 months straight of their foreign reserves falling. This comes after September, which is when they started intervening to save their currency. As we've talked about a few times, their currency has been virtually failing and it has been falling versus other currencies like the dollar extremely quickly. This prompted them to intervene on the 22nd of September for the first time in years to try and prop up the value of their yen, which ultimately failed and caused them to have to intervene again about a month later on the 21st of October. Now, in order to intervene in your currency's decline, that means you have to be selling something so you have the purchasing power to buy back your own currency. You can't buy back your own currency with your own currency. There's got to be an exchange going on, hence foreign exchange. And so what we're doing here is selling reserves of foreign assets and then using purchasing power from that to buy back the currency here. When you buy something back and add that much buying pressure, it's going to bid up the price and stop the price decline. But since you have to sell something in order to do that with Japan, they've been selling their foreign exchange reserves, and they are now at 1.19 trillion, which is still the second largest after China, but it is the sharpest month decline on record. Now, new records happen all the time, so it's helpful to see some sort of a visual so we can understand whether, hey, is this really out of the ordinary? Is this just some random spike, or do we see a new trend occurring here? Let's take a look at a chart. This is the month-on-month change in Japan's reserves. You can see that for the last 15 years or so, it's been pretty steady. For the most part, they've been buying and every once in a while do a little bit of selling. But it looks like recently, especially since the start of 2022, there's been a severe change in the normal pattern for Japan. And in fact, they've been selling more and more aggressively and more frequently. Now, you might be looking at this and thinking, yes, it's accelerated recently, but they've got $1.2 trillion worth of foreign reserves that they can tap. Clearly, the yen is in no problem, right? Well, first of all, if it was that simple, they may not have allowed their currency to get to this point already. If we look since the late 80s, the yen has been on a clear trajectory, a clear trend upwards, and it recently broke the bottom line of that trend back in May of 2021, and it has fallen to levels that it hasn't been at since the late 90s and especially the late 80s, early 90s. So the question is, why have they let it get this bad, and why can't they just start tapping the $1.2 trillion in reserves that they have, just start selling like crazy, buy back the yen to stop it from falling? Well, it comes down to what exactly they have to sell in order to buy back their yen. We can see that by asset type, it's mostly foreign bonds, and of that, mostly US Treasuries. And it's those US Treasuries that they are likely having to sell the most of, and they saw their second largest drop last month to 941 billion. And here is where we get into the problem. There are very few buyers of US Treasuries right now. The United States is still experiencing deficits in their budget, which means they're spending a lot more than they're bringing in from taxes. Every time they do that, they have to borrow money in order to do that. When the government borrows money, that creates a bond. It's an auction. They have to sell new debt. There's got to be a buyer, a lender, somebody willing to buy that debt and lend new cash to the US government. So the US government right now is creating more supply of US Treasuries. At the same time, we have the Federal Reserve trying to combat inflation by doing something called quantitative tightening and selling assets off their balance sheet. Their assets are, guess it, US Treasuries. And so we got the Federal Reserve with a giant stack of trillions of dollars of US Treasuries selling them. And now we've got the biggest holder of US Treasuries, Japan, who is also needing to sell these US Treasuries so that they can defend their currency. So we've got Japan, the Federal Reserve, and the United States government all selling US Treasuries. Is it any wonder that we've seen such a huge rise in the yield on the 30-year, the 20-year, the 10-year, and the 2-year? When all the biggest buyers in the world suddenly all turn into sellers at the same time, that is a lot of selling pressure. There's not enough buyers to soak up all that selling at the old prices. And so the prices have to come down, which means for bonds, those yields have to go up. Is this a problem? Not yet. But it is a problem brewing. Because let's say you have 10 credit cards that are all maxed out. You're on your 0% intro APR on these credit cards, but they're staggered. The first one goes to its regular interest rate of 25% this month. You can absorb that blow. Your expenses will increase a little bit. But next month, your next credit card does the same thing. And the month after that, the next credit card does the same thing. So it's not a problem right now, but it's kind of baked into the cake already. It's going to be a problem in a few months. And it's the same thing with US government debt. It's not a problem right now, but at the current pace, if things keep on happening the way they are. Japan keeps on selling to defend the yen. The United States government still runs deficits and doesn't bring in enough in taxes to pay for all its expenses. And the Federal Reserve has to continue fighting inflation, so they continue to sell US Treasuries. At some point soon, probably within the next 2 to 3 years, then you get to an issue where the US government just can't afford its current debt load. Because to take on that new debt, to pay off that old debt, the expenses are too high due to the interest rate. Now, I think we're probably going to have some sort of event far before then that will cause the Federal Reserve to stop selling treasuries, and they'll have already been buying them at that point. So we'll see. But as for now, if things keep on going, it's baked into the cake. It's baking that cake even more and more and more. And we are seeing this slowly turn into a problem as the biggest holders of US Treasuries in the world that used to be the biggest buyers are now selling at increasingly fast paces. And the kicker here is that it's not just a problem for the US government and their treasury rates and the cost of borrowing. This is pushing the cost of borrowing up across the board. Because if suddenly you can get 5%, 6%, 7%, let's get crazy here and call it 10% just to loan money to the US government, who you know at the end of the day, if push comes to shove, they can do anything they want in order to pay that back to avoid a default. They can tax, they can military, they can inflate it away, they can get the Federal Reserve on board. Anything to avoid a default, you know, hey, well, look, how much risk am I willing to take on? If I can get 15% just to lend to the US government risk-free, well, then I'm not going to lend to a private corporation at 10% that has a risk of bankruptcy. And so in order for a corporation who needs capital to attract funds, they're going to have to be willing to pay a much higher rate that they probably can't afford. So borrowing costs go up across the board when something like this starts to happen. Then you get bankruptcies, then you get crashes, then you get severe recessions, severe depressions if nothing changes. And guess what? Assets go on sale. If you don't already have it, get my bear market investing guide that teaches you how to identify the best companies and figure out what price you should be paying for those companies, linked in the description below. As always, really appreciate you guys. Thanks so much for watching. Have a great day.